So you've had franchisees that maybe they came from a good bookkeeper. Maybe they were a really good bookkeeper or CPA. They were just too expensive. They wanted to go to a different place. Maybe they were part of a really part of a CPA, had a CPA that was just not very good, cutting corners, just not good. What are the not good things that you see other CPAs doing out there, and they get to you and you're like, I'm glad we got these guys as a client because now we're able to help them with X, Y, and Z. What's the X, Y, and Z?
Yeah. So most times when we get an engagement, the things that are going to be that we're automatically going to redo on the books is we're going to redo revenue, we're going to redo payroll, we're going to redo royalties. In that most accountants and bookkeepers, to fully understand a franchise and grasp all those different places that you're gathering that information, it just takes a lot of time. And usually they're not, either they didn't budget for it. In all honesty, a bookkeeper just didn't budget an amount of time. And when your bookkeeper leaves you, it just becomes so painful. We have turnover, like every accounting firm has 14% turnover. That's just industry rate. So you're going to have new people on your team, but they're going to be surrounded by 5 people that know what they're doing here. So if someone's new, they're going to have 2 people on either side of them. And it's just levels of review and frequency of talking to clients. Most people don't talk to their CPA until year end or until tax time. We want to talk to our clients almost every month for as long until they get the report and they know, hey, I'm doing good or I'm not doing good, or I don't know. Until they know what they're doing when they get that, we have basically a benchmark chart where we say, hey, these are your 80% of your expenses that we should focus on. We want them to be able to get that report and go with it. From a CPA standpoint, the hard part right now is just taxes just keep getting more and more complicated. 2022, there were, as of 2022, there's 29 states that have passed through entity tax. And even some of our clients, admittedly, do not know what pass-through entity tax is. And it's one of the most groundbreaking tax laws that have come out since I've been an accountant.
So who knows about this? Put in the chat. Do you know about this or not? A yes that you do, a no that you don't.
And depending on your state, you're going to know. So if you're one of those 29 states, you may know. And if you're not, it's good that you don't know because it doesn't exist.
Tell me about it. I don't know about it.
All right. So pass-through entity tax is something I'm going through with all my clients right now, or in those 29 states. It allows for a deductible state tax payments, a federally deductible state tax payment. So right now on your personal return, everyone knows that their state and local tax limitation is limited to $10,000. What everyone doesn't know is that a lot of states change the ways that they collected taxes using this pass-through entity tax. Connecticut has been one that's been doing this for maybe 5 years. And when Connecticut went this route and they made state tax payments deductible, we said, all right, this can't last. They're just going to change the rules, right? The IRS is going to change the rules. They're going to see the loophole. The point of limiting the state and local tax limitation was to get rid of it. It wasn't for everyone to change the rules so that you can then deduct it. Well, here we are in 2022. Now there's 29 states that are opting in. So California, Oregon, Arizona, New Mexico, a bunch of these states. Now, if you're going to owe state tax payments, it's beneficial to make these payments through your business entity because they're federally deductible. Meaning if your business was going to show $100,000 in income in New Mexico, you're going to want to pay your New Mexico taxes with the filing of that business return, because you'll then be able to lower that $100,000 by, we'll say New Mexico, it was a $5,000 payment. You're only going to pay federal tax now on $95,000. So instead of having that $10,000 limitation, which a lot of people hit with their real estate taxes, depending on where you live, that could bring you right up to the $10,000. With sales tax on your personal return, everyone has a sales tax calculation that's factored into that. So the nice part is that it is nice to actually have Todd and I worked this way for a very long time, where you have someone that is looking out for the best interest in the business side, and you also have a professional who looks out for you personally. It doesn't have to be one person, and a lot of times it's even better when it's two different people because you have meeting of the mind. So we work extremely well with CPAs. We can also do it all, but a lot of times your personal returns it's a very personal service, and to have that remote is not for everyone, for sure. But Todd and myself and Todd's old personal accountant, we worked together for years. We did projections. We were always looking out for, hey, what can we do on the business side to help his personal accountant on the personal side? So the CPA versus bookkeeper mindset is challenging, because if you want to get bookkeeper pricing, you're not going to get the CPA level of tax knowledge. And to be honest, myself training people in our own organization, it's challenging to take someone and level them up. It takes years of understanding and grasping. And we have 40 hours of continuing education every year minimum. And we probably double that, learning all the new tax laws, and they change. There could literally be changes tomorrow for last year. Everything that I could say today could end up going, nope, they finally got rid of it because too many states are trying to enact in this, and they're going to squash it.